Here's the latest. Treasury's holding steady. Traders spurning a sale of 10-year notes at lower yields, and a sign that the recent bond market rally may be losing some momentum. Tony Rodriguez of Nuveen writing this: we expect the 10-year to end the year close to 4%. We believe we have seen peak curve inversion and expect the curve to remain close to flat moving forward until it steepens more in 2025. Tony joins us now for more. Tony, good to see you. Two time frames there. So we've got going into year end, then we've got a different theme out into 25. Let's start near term. What are the forces going into year end, which basically leaves this bond market where it is at the moment?
So right now we think the forces that leave the longer-term bond market where it is at the moment is that we have a slowing economy. So the Fed has moved from a single mandate, inflation fighting only, to now a more balanced mandate where the risk to the employment market is becoming front and center. We think that is going to shift to where that is the primary driver of Fed activity. So when we look at the long end of the market, we think that's already priced in quite a bit of that slowness, right? We were in the high fours, we're now in the high threes. We think four is kind of fair value. It's the funds rate that has not caught up yet to the market, and we think we'll certainly begin that process in September. But they're behind the curve in terms of where the funds rate is today.
Just help me understand something. On inflation, are you just acknowledging they're going to accept a higher inflation rate above target inflation, or do you just assume that inflation will come down as this economy decelerates?
We think that inflation will come down as it decelerates. It's going to be slow. If you look at where we are right now, core PCE 2.6 year over year, but 3-month annualized is at 2.3. So we're moving in the right direction. We think we'll end the year around this level, 2.6, 2.5. But by the time we get to the middle of next year, we'll be down into the 2.3, heading towards 2% in early 2026, we'll call it. So it's going to be slow and gradual. But while that is happening, we think we slow down from a growth pace of what's been 2.5 to 3 down to more of a 1.5%. And that's when at that rate of growth, you're certainly more susceptible to any kind of exogenous shocks that might hit the economy. Things like what we saw with just market volatility over the last week. So that's where we think the Fed's going to have to react a little more aggressively as we move through the next couple of quarters to get the funds rate in line with where we see longer term rates.
I want to ask about that volatility and where it leaves us specifically with credit, because you've had this type of move that you haven't had for some time, that is widening. Take high yield spreads in the past 3 days blow out to 67, that is through Monday, and then they have coming up into today. Where does that leave us?
So we think that it leaves us today much closer to what we would call fair value. When we were sitting at 300 over in high yield, we were sitting at 90 over in investment grade credit. That was clearly pricing in quite a bit of good news. Solid credit fundamentals, continued growth, steady pace of maybe, rates coming down a bit. Right now, the move that we saw, while it was big, it was coming off a tight level. So it's not as worrisome in the sense that now we're getting closer to fair value. We call it fair around 350 in high yield. We've been kind of around basically a little above and below that recently. That seems like fair value. We think there's opportunity there. If you saw the high yield market widen from here, another 100 plus basis points, that would be reflecting a more material risk of hard landing than we think there is in the market today.
Well, just looking at what happened yesterday, I'd have to assume a lot of people agree with you with just this mountain of issuance we get from investment grade companies. Something like $30 billion, the most of this year. Meta has something like a $10.5 billion offering, and people hoover this thing up. People are happy to buy it. Is there some degree which companies aren't being tested, that the supply is such that people are really happy to absorb it, and some of the issues with some of these individual companies are getting papered over?
Well, when you look at the investment grade market, there is a lot of appetite there. And partly it's because credit fundamentals are solid, so we don't expect significant downgrades. We think that, whether you look at interest coverage, whether you look at debt to cash flow, those metrics, while they're a little weaker than at their best levels of the last 2 years, they're still in very solid territory. And you look at the yield that's available there, and you're getting 5.5 to 6.5%. That's a very attractive return for all kinds of asset class allocators in a very high quality, relatively low volatility asset. So supply's up 20% year over year. Easily absorbed. If we saw that kind of 20-25% year-over-year increase in dicier parts of the market, like really low-quality credit, in this environment of economic slowing, that I think would be a little bit more difficult to digest. And obviously where the supply is greatest is in the Treasury market. That's really where the balance sheet is probably weakest as we look across consumers, corporations, and governments.
I want to ask about the wobbly auction yesterday. How much do you think in investors' mind that they're actually going to start thinking about, I don't want to sound like Lisa here, but the health of the U.S. trajectory when it comes to the fiscal deficit?
We think it's going to be, at the earliest, a kind of mid-2025 issue for the markets. The reason we had, I think, a sloppy market is because you had this huge run over the last week. So the actual value available at a, sub 4% type of yields is really not that attractive. So that clearly moves some demand to the side there. But at that fair value level of 4%, we think auction sizes as we see them through the balance of the year, those are going to be relatively digestible. We'll have some sloppy auctions, but generally I think they'll be pretty solid. But then looking into next year, because we're not going to do anything to address our fiscal deficits, that supply is going to continue to be large. That's when I think we're going to have maybe a little bit more possibility of auctions, not failed auctions by any stretch, but certainly ones that don't get digested easily. So
you think we maybe get a repeat of what we saw briefly in 2023, coming out of the summer, going into the back end of the year, I think through to the end of October?
Yeah.
When supply starts to matter a little bit more again and yields start to climb?
I do. I mean, we don't think it'll be a, British gilt market replay type of storyline.
A Liz Truss moment?
A Liz Truss moment, because there's just deeper pockets of demand for the U.S. asset. And as we see that slowing economy that we're expecting, clearly there'll continue to be a big flight to quality, bid to the Treasury market. And yields at 4% plus or minus are still pretty attractive from an absolute return and income perspective.
What's the dominant force then behind that 2025 steepener that you're looking for? Where does that come from? The Fed finally catching up to the market in terms of the front end. You think it'll be that late? I do. I think because the market right now in the front end, if you look at 2s, 3s, 5s, they've already priced in a lot of the Fed cuts. So flat curve at the end of the year had been our forecast as of the first quarter, with some modest steepening from there. But when we talk about steepening, I'm talking about a funds rate to a 2-year that might get eventually to 25 basis points, 2s, 10s that might get eventually to 35 to 50. So that's the shape of the curve. That's the difference between the two. Walk me through levels. Where are those individual things? We think it's 4% across the board at the end of the year. Okay. And then we think you can get down to like a 3.5 on the 2-year. That'd be a target level. So you've got like Fed funds at 325? Exactly. Ultimately, we think that's the long-run equilibrium level, which is why we think the Fed right now is pretty far behind. It's a very restrictive level right now when you look at the real yield of the Fed funds rate. So even if you took 100 basis points off of that today, you're still at a restrictive level, just not as restrictive, but probably more in line with what the current balance of risks is on the inflation side and the employment side.